welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following on hashtag QC Weekly Comment on LinkedIn. I'm your host, Fraser Wilkinson, investment manager based out of our Leeds office. And this week we have our podcast stalwart, Richard Carter, our head of fixed interest research. Good morning. During the Truss era, we were told that crashing the economy was defined by the percentage increase the UK government has to pay on interest rising sharply. This has knock-on effects on mortgage rates and pension funds and can cause some alarm. In October 2022, when Truss resigned, the required yield on 30-year UK government bonds was around 3.6%. Today, it is around 5.6%. Is the current government crashing the economy, or do we need to take things with a pinch of salt? What do we need to look out for in the future to tell us how they are doing?
Yeah, Fraser, that's a great question, and this has been coming up a lot recently. And in fact, we're in the middle of writing an article on it, which we'll be sending out, talking about some of these issues, because clearly, there's a lot of concern that the Labour government is struggling to get borrowing under control. A couple of the things I would pick up with your question. I mean, yes, the yield when Truss resigned, the 30-year yield when Truss resigned was 3.6%, and it has gone up a lot since then, but it reached almost 5% during the mini budget crisis. So yes, we are at high levels on that, but after Kwasi Kwarteng, I think, was replaced with Jeremy Hunt, those yields did start to come down before Truss left. The other thing I would say is it's higher, longer dated yields is one measure. You could also look at the currency, and the value of sterling is quite significantly higher and has been heading higher this year, which is in some ways a bit of a vote of confidence, albeit as I say, higher bond yields is not ideal. There's a lot going on at the long end of the gilt market, and it's more than just what's happening with government borrowing. We have seen the Labour government's efforts to get spending under control be kind of dashed by opposition from within the Labour ranks, and we've seen a number of U-turns on things like the winter fuel allowance and cuts to welfare benefits. But that's not the only factor. We've got the issue of fairly sticky inflation in the UK. So inflation worries do affect the gilt yields, particularly at long end. And we've also got structural factors taking place. So in the last sort of 20 years or so, the government could get away with issuing tons of longer dated bonds, and the pension funds with their defined benefit schemes would hoover them up happily. That's changing now. There is not so much demand from pension funds. And at the same time, you've also got the Bank of England unwinding its gilt holdings that they built up under quantitative easing. So there's a lot of different factors, and but those longer dated bond yields, yes, they are a bit of a concern, and markets are going to be watching closely for the budget, particularly towards the budget in October or November, to make sure that the government is sticking to its fiscal rules.
Absolutely, and fingers crossed. One of the things looking in portfolios is the difference between short-term loans that the government seem to issue and the long-term loans. In October 22, the average required yield on the 5-year UK government bonds was around 3.6%, and today it's around 4.1%. So it doesn't seem to have moved quite as much as the longer dated bonds, which take a long time to mature. Could you help our listeners to understand the difference between short and long-term bonds? Is there anything we can learn about what the market is expecting when borrowing for the long term costs a lot more than borrowing for the short term?
Yeah, it's a good question. So the shorter dated gilts, we would typically talk to, between 0 and 5-year gilts. Very much the yields are determined by what the Bank of England's doing. So if Bank of England's raising rates, you'd expect them to be rising. And as Bank of England's cutting rates now, those yields have come down a little bit from the peak they reached a couple of years ago. So, yes, Bank of England rates are 4% at the moment, base rate's 4%. As you say, 5-year yields around 4% as well. So there's a strong kind of link between the two. Longer dated yields, what the Bank of England does matters, but also, as I say, inflation expectations matter, and supply, particularly gilt supply and the demand for the bonds that are being issued. So the gilt market is one of the longest maturity bond markets in the world. There's a lot of longer dated issuance, and so that's obviously what happens there is very important. But the UK debt, so the DMO who issues or sells the gilts for the government, they've been reducing the maturity of their bond sales, so that the average maturity of the gilt market will gradually be coming down. But yes, I mean, in terms of the difference between the two, it can tell you a lot of things, Fraser. I mean, if you've got lower, shorter dated yields than longer dated, which we have now, that might tell you that the market's concerned about government spending or government fiscal problems. It might tell you the market's worried about inflation. It might just say that the economy is coming out of a weaker period and we're expecting rates to go up over time. It's not necessarily a bad thing. It might just be a harbinger of sort of economic recovery. But I think at the moment it's definitely related to fiscal concerns. And honestly, I think we're going to come on to this. The UK is not alone in this. There are plenty of fiscal worries around the world, not least France and the US. So yeah, the UK is a concern, but it's not the only one.
Yes. I guess it's trying to understand if it's a normalization or something deeper. In portfolio terms for our clients, some clients may be aware how rising yields that governments pay on their debt affects the value of their investments, but some may not. Could you just walk us through how rising yields affect the bottom line? And are there any investment opportunities at the moment? I've got to admit that the number 5.6 guaranteed by the UK government sounds a lot more attractive these days.
I totally agree with you. I mean, 5.6% on a long dated bond does look attractive. If you look at longer dated index linked bonds as well, you've got the opportunity to lock in around 2.5% plus inflation for the next 20 years, which sounds attractive if you can put up with the volatility, Fraser. I mean, you might be very happy with 5.5%. For 20 years, but clearly there could be some big volatility on that, and so it might not be for the lower risk, more cautious portfolios. How does it affect portfolios? I mean, it does vary. So if certainly at Quilter Cheviot, if you're a lower risk investor, you're not really going to be exposed to the long end of the gilt market, to be quite honest. It would be a very modest part of your bond portfolio. You're generally going to be more invested in the sort of 1 to 10 year area of the gilt market, and maybe some corporate bonds as well. And that area this year has done pretty well. So that's quite reassuring. If you've got a sort of medium to higher risk, you may have a bit more exposure to longer dated gilts within your portfolio potentially, but you're also going to have other things like corporate bonds in there, and you're going to have probably a higher weighting in equities. So I would say that the impact on portfolios certainly this year relatively minor, because the fact that some longer dated bonds not doing so well, but then corporate bonds have done pretty well this year. If you've got a sort of shorter dated gilt, that's up probably 3.5% year to date. So it swings and roundabouts a little bit, but I do think, like you say, for clients who can stomach the volatility, there's definitely some opportunities there.
Absolutely. And we keep our eyes sharply peeled on our regular morning calls. Looking around the world, similar to the UK, France has been hitting the headlines, which listeners may have seen over the weekend, with similar talk that they are running out of money and might have to beg for a loan from the International Monetary Fund. Sure, there's a lot of politics and spin in what the authors are saying, but looking at France, in October 22, the average yield on their 30-year bonds was around 3%, and today it's around 4.4%. So it doesn't seem to have moved quite as much as the UK rate. Could you help our listeners understand why can France borrow at a cheaper rate? Are they doing better? And why has their interest rate not risen as quickly as the UK's in the last 3 years?
Yes, I think it's interesting, all these sort of horror stories about the IMF and going back to sort of bailouts and all this sort of stuff. The IMF is more designed to help emerging markets these days, and I think if you have a sort of gilt market or a French bond market crisis, it will be the central banks intervening, not the IMF. But it makes a good headline, doesn't it? I mean, yeah, it's difficult. It's a bit, are we comparing apples with apples really? Because you've got to remember the rate in Europe that's set by the ECB is about 2% at the moment, whereas the base rate in the UK is 4%. So, gilt, you can't just say, oh, well, we've got a high yield or something, and that therefore means there's more risk in the UK market. You've got to look at where interest rates are priced in that currency, and in Europe, in euros, they are significantly lower. I think the best thing to look at with France is compare it with Germany. So people compare the yields with the German yields, and increasingly with Italy. So Italy used to be the big kind of risk in the European bond market, along with places like Spain and Portugal. Well, now Italian yields and French yields are pretty much the same. So the market is worried about France, and it looks like we're going to have yet another prime minister soon, albeit growth in France. And actually, growth is not too bad. Inflation is not too high either, and it's just that the politics is unpredictable and unstable. But I don't think there's any great sense of panic at the moment.
Well, that's good to hear. I guess we can't talk about global politics and economics and avoid the elephant in the room. So turning to the same metric, the 30-year US bond yield was around 4.2 in October 22. Interesting to note that was higher than the UK's average. But in the last 3 years, the required return has risen from 4.2 to 4.9. So it's almost a smaller rate of increase in the US than even in France and the UK. What can we learn from this? Underneath it all, is the US doing better than Europe over the last 3 years, or is the news correct in telling us otherwise?
Well, I think the fact that the yield was initially higher going back a few years probably related to the fact that growth in the US was better than in Europe and the UK. So, interest rates were really higher and growth was quite strong. So yields kind of were reflecting that. I think it's interesting. You mentioned elephant in the room. I mean, what's going on with the Fed? His attacks on Fed independence, even sacking the sort of data chief because he didn't like the non-farm payrolls numbers. These things you just could not imagine in the UK. And I think if it happened, I think the bond yields would be more closer to 7, to be quite honest. The US seems to be able to get away with quite a lot because there's always a lot of demand for US assets and US treasuries. Whether that will change, we shall have to see, because you say what you like about Rachel Reeves and Labour Party, they are trying their best and they're kind of sticking to orthodox policy, whereas Trump just seems to rail against anything he doesn't like, and say these attacks on Fed independence are a worry. There is also the technical factor. In the UK, there has been a lot of selling of long-dated gilts by the government to raise money. In the US, there's less of that. They tend to issue sort of shorter-dated bonds, so that maybe helps. But I think overall, it's this solid demand for US assets that may weaken if Trump carries on the way he's going.
Yes, I think unorthodox is perhaps a little charitable. Well, last question on maths, I promise, but it's just a sort of summing up for our listeners to try and understand, because we're quoted these numbers quite a lot in the press, and it's just for the ordinary investor to understand. The UK long-term rate stands at 5.6, France at 4.4, and the US at 4.9. So, killer question, Richard. Which is the best investment?
Yeah, it's a great question, Fraser. I think the most important thing to start with is to mention currency. So if you're a sterling investor and think, yields in, let's say, France or US or wherever look attractive, and you're taking currency risk as well, that's a whole different kind of ball game. You really need to think about what the dollar or the euro is going to do against sterling. And the volatility of those currency movements will far outweigh probably what happens on the bond side. You can buy those assets hedged in some formats, but that may, there may be some costs around that. But I think for me, the UK probably stands out as the most attractive because although there are worries about the government's ability to cut the deficit, they do seem to me to be trying to do the right thing. If you can be patient and you're not obviously taking currency risk by buying gilts, I think potentially that's quite an attractive return. As I say, I do think the real yields on index link, which have some sort of inflation protection in them, are pretty compelling. But you need to be able to stomach the volatility of the longer dated bonds, certainly for some time, I think.
Well, that's great to hear some optimism. And I've got to admit the press only seems to sell papers by giving us doom and gloom. So perhaps a bit of a reality check there on the investment front. So just lastly, generally, are you optimistic? Portfolios have recovered nicely since that April tariff tantrum where they dipped. And how are things looking towards the rest of the year?
Well, I think the market's taken an awful lot in its stride this year. I think given what's going on with tariffs, I think the performance of markets has been nothing short of incredible, really. I mean, I know there have been, some wobbles here and there, particularly around Liberation Day in April, but the recovery has been, pretty amazing in my honest opinion. And it just shows the resilience of stock markets, particularly with the whole sort of AI trade going on. I mean, I am fairly optimistic going into year end. I still worry about the geopolitics, obviously, and everything around that. I worry that at some point the market will be more concerned than it is at the moment around what Trump's doing to the Fed's independence and all the rest of it. But I think markets can look forward to interest rates continuing to come down. There's plenty of scope for the Fed to cut rates, from where they are at the moment. Bank of England too has got scope to cut rates as long as inflation is reasonably well behaved. So yes, relatively optimistic going into the year end, but clearly, the whole geopolitics around Russia, China, Ukraine is still a concern.
Well, that's great. I guess 'twas ever thus. Well, thank you very much, Richard, for those great insights. And thank you to all of you for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners. So please review the show now, wherever you're listening, and share it on your socials and tag us at Quilted Cheviot. To make sure you don't miss a future episode, tap the subscribe button. We'll be back next week. And in the meantime, do head over to our website, www.quiltedcheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. Finally, do you have any questions that you would like to ask one of our experts for our next podcast? Simply ask them via the weekly comments page on our website. We do love to hear your questions. And that's it for today. So thank you, Richard, for your time today, and all of you for listening. See you next time.